Welcome to Stock Informer for you. The noise in the market is loud, but we prefer to let the data do the talking. L&T Finance is absolutely on fire right now. Trading at around 324 rupees a share, its retail loan book is exploding at a massive 27% year-on-year growth rate. Wall Street and Dalal Street are loving the transformation into a pure retail lending machine. But behind every massive rally, there's a hidden question. What happens if the economy takes a sudden turn for the worse? In today's video, we are breaking down an institutional-grade stress test on L&T Finance. We're going to put this stock through a worst-case macroeconomic nightmare to find out its true margin of safety and calculate exactly how far the stock could drop if things hit the fan. If you own this stock or are thinking of buying it, you cannot afford to miss this. Let's dive in. The golden baseline, where things stand today. First, let's look at the baseline. To understand the risk, we have to look at how good the business is performing right now. As of their latest Q1 FY27 data, L&T Finance is managing a massive asset base under management, or AUM, of nearly 1,29,634 crore rupees. The biggest takeaway here is their retailization strategy. Over 98% of their focus is now on retail loans. Think rural business loans, urban finance, and consumer loans. They've effectively moved away from risky, large wholesale infrastructure projects. Because of this, their net interest margins, or NIMs, are incredibly healthy at 10.47%. Their asset quality is also looking solid. Gross NPA stands at 2.86%, while net NPA is a tiny 0.90%. If we look at their book value per share, it sits at roughly 112.65 rupees. This means at today's stock price of around 324 rupees, the market is valuing L&T Finance at a price-to-book multiple of about 2.88 times. In a normal, healthy economic environment, this is completely justified. In fact, our base case projection for the upcoming quarter puts the fair value closer to 349 rupees, assuming they maintain an earnings run rate of around 960 crore rupees. But what if a shockwave hits the financial system? The 10-point nightmare stress test. To find out how safe your investment really is, we subjected L&T Finance to a brutal 10-point stress test. We wanted to see what happens if credit costs spike, margins compress, and funding channels dry up all at once. Here is the worst-case scenario breakdown. Point 1. The credit costs spike. Right now, credit costs are low at 2.54%. We modeled a sudden 200 basis point surge to 4.54%, which hits the balance sheet with an extra 650 crore rupees in quarterly provisions. Point 2 and 3. Margin compression and liquidity freeze. We squeezed their net interest margin by 50 basis points. Simultaneously, we simulated a freeze in short-term commercial paper markets, forcing their cost of borrowing up from 7.20% to 8.00%. That's an immediate hit to their net interest income. Point 4 and 5. Asset quality and concentration shock. We assumed localized rural economic distress that pushes gross NPA up past 6.3%. Plus, we simulated total write-downs on their remaining 893 crore rupees wholesale project finance portfolio, points 6 through 10, operational and capital drag. We factored in rising compliance expenses, a cybersecurity operational penalty, and a drop in capital adequacy from 17.89% down to 15.45%. Finally, we applied a massive market derating. In a panic, investors won't pay 2.88 times the book value. We knocked that valuation multiple down by 25% to just 2.16 times. When you compound all 10 of these shocks together, the results are staggering. The discovered stressed value, a side-by-side comparison table showing the normal base case versus market price versus stress-tested case. When you run these numbers through a financial model, the baseline quarterly profit of over 900 crore rupees completely evaporates, tipping the company into a minor net loss for the quarter. More importantly, the asset write-downs erode the core book value per share from 112 rupees and 65 paise down to 110 rupees and 15 paise. Now look at this table. If we take that stressed book value of 110 rupees and 15 paise and apply our panic scenario market multiple of 2.16 times, the discovered fair value of the stock drops down to 237 rupees and 92 paise. Compare that to the current market price of 324 rupees and 70 paise. What this tells us as analysts is that the market is currently pricing this stock for absolute perfection. The current price has almost zero margin of safety built into it for a severe economic downturn. If the macro environment gets ugly, L&T Finance has a potential downside vulnerability of about 26.7% from where it trades today. What management is saying behind closed doors? Now, to be fair, a stress test is a hypothetical worst-case scenario. To balance this out, we listened into their latest corporate discussions to see how management plans to protect the company. On the positive side, they are hyper-focused on growth. Their digital lending app, Planet, has over 2.5 crore downloads. They're using AI-driven cross-selling to grow their rural and urban retail portfolios by 24% to 26% annually without the massive overhead of opening physical bank branches. Furthermore, their liquidity buffer is massive, with a liquidity coverage ratio of 325%. However, management did admit to a few key risks. Analysts heavily questioned them during the conference calls about early-stage stress and collection challenges in specific rural pockets. They also acknowledged that tightening regulatory guidelines from the RBI regarding unsecured consumer loans could restrict how fast they can expand their leverage moving forward. Final verdict. So, what's the final verdict? L&T Finance is fundamentally a much stronger, safer business today as a retail lender than it was years ago when it was bogged down by corporate wholesale loans. If the economy stays strong, the stock could easily march toward our base target of 349 rupees. But at 324 rupees, you are buying at a premium. If you are a long-term investor, you need to ask yourself if you're comfortable holding through a potential 26% drop if systemic credit risks return to the NBFC sector. Keep a close eye on their credit costs and rural collection efficiencies over the next 2 quarters. Thanks for watching. If you found this institutional deep dive helpful, hit that like button. Subscribe for more institutional grade stock stress tests and let me know in the comments below. Are you buying, holding or selling L&T Finance at these levels? See you in the next video.